You have entered into the black hole of real estate, a place for industry news, tips, and strategies. Once you enter into our vortex, even if you could leave, you're probably going to want to stick around. I'm your host, Ron Weiss-Sikarski, and you are now entering the black hole of real estate.
Well, I am excited to be back with you again for another episode as we get into the second to last part of the summer. We're just approaching September right now, and that's how I like to look, the second to last part. And school's getting back in session, and the sales reports, while they've slowed a little bit, are still, well, they're still kind of hot out there. There's some interesting thing going on with some of the student loan calculations for borrowers that are trying to qualify right now. And also, debt to income ratio is something that's really playing into first-time home buyers' minds that I want to talk about today. So at the end, it might be just a little bonus feature. But right now, let's get to some numbers in the Daytona Beach area sales reports. The month of July showed that, if you will, things slowed down just a little bit. And in June, we had about 555 sales compared to July 510. So a little slowdown, but still way over 500 and a good month. Median sales price, it checked in a little above the month of June, 320 compared to 326, so up about almost 2%. It's a pretty strong number for 1 month, so also interesting to see. Now, what else is going on that would really speak to the numbers? Last year, if you look at July 2020, 609 sales, and you say, well, shoot, we lost 100 sales in this year. What happened? Well, what happened was last year, if you remember, with all the lockdowns, about 3 months worth of closings all got rolled in the month of July and August. So things were delayed. So we expected to see less than last year, but we're very close to being on par with what we've seen this year. And if you're going to go back 2 years, there was 527 sales in July of 2019, 510. So we're within a small amount. So that July range is holding true, and it bodes well for the rest of the year. The inventory continues to be a story, but I got to tell you, we're getting a little better. You know, in July of last year, year ago, even with all of the just gridlock we were in because of COVID, was a little over 1,800 homes that were for sale. And fast forward this year, about 1,248. What's interesting on top of that is that we're up 3-4% from June of this year, because that was just 1,207. So we're at 41 more homes to choose from. And it's another few percent, and it's trending in the right direction. And as we continue towards the end of the year, that 3 to 4% will probably grow to 5% increase, and the number's bigger, so the listings will get bigger. And we could have a self-solving problem, by the end of the year. And we start adding 50, 60 extra properties on the market on a consistent basis. And with sales tending to taper off a little bit towards the end of the year, we'll see. That could go a ways to getting the inventory to a more normalized area. Now, keep in mind that even last year with 1,800, it was still a low number. 2,500, 3,000. That's a pretty big number where the market balances out. But we're behaving well in this market, and we've got a 2.5 month supply of houses, so we're getting towards 3. 6 is considered pretty much neutral, but I think our market behaves really well in that 3 to 5 month range, and we're getting towards that. There were some really good sales in our market in the last month or so. A couple of $1 million sales were in there. But also, what's interesting is this median sales price. Even some of the surrounding areas, when we look at Beachside, 394 for a median sales price, and 395 in Ormond. New Smyrna, 444 median sales price. Now, it's a small sample of about 50 sales. And Port Orange kicked in at 332. Mainly in Daytona, 252. So that's moving up as well. Now, I don't spend a lot of time on median sales prices, but it's not an average. It's just the one that's in the middle. And it has been a pretty good indicator over the years. What I'd say is median sales prices continue to climb. That's not so much of a shock, but we were expecting, at least some people, some retracement. I would not be in that camp. I think that prices will continue to increase ever so steadily between now and the end of the year because of the just significant amount of cash buyers in the market. We've talked about how cash buyers from other cities are coming where the median sales price is 4, 5, 600,000. So even a price of 300, they don't bat an eye. They're thinking, I sold my house for 600. I buy my replacement house in Florida for 300. I got 300 grand left over. I'm okay. So the price is not as big of an issue. If there is a pain point in the market, it's that move up buyer. It's the one that has a 2-bedroom house or a 3, and now they need an extra bedroom or 2 because their family has grown. That's the one that's going to be a really tough one as time goes forward, because to get that extra bedroom, that might be an extra $50,000 or $100,000, and that's a big steep number. Now, as long as interest rates are low, it's manageable. But if interest rates go from 3 to say 5%, that payment, well, it's going to get in the way of things. We're going to keep talking about that. So we're going to keep a close watch on the interest rates to make sure that when that squeeze shows up, that we're going to be able to talk to you about it. Student loans. A good guide came down talking about how now they'll actually be able to work out the percentage of the payments and apply that if your student loans are in deferment, maybe just finished college. The 1% factor is going by the way of what dinosaurs and things like that. Unless dinosaurs come back to life, we'll be okay. But what does it mean to you? It means that we'll be able to see more loans calculated on the actual debt versus what the perceived debt might be based on 1%, because there's some super low interest rates out there that could help get a few $100s back into the qualifying side for our first-time home buyers and recent graduates looking to purchase a home instead of renting. Now, debt to income ratio, I'm just going to say a couple things about it and move on from it. It's just a calculation of how much you make versus how much that you're spending, and there's a ratio in there that banks like to see, less than 50%, usually 45%. And being able to control your student loan payment and debt is one way to help it. I would just say this: if you're thinking of buying a house and a car, buy the house first, because that big $500 down payment is going to look awesome in the driveway of your rental and not your house if you purchased before, because you might not qualify for the house that you want. So delay the gratification of that shiny new car until you get the house. And by the way, with the price of cars right now, who's actually in a hurry to go buy one? Because I'm not usually afraid of spending money, but I definitely got some sticker shock when I was just playing around looking at what it might look like to have a different vehicle. I think I'll be holding off and not doing that just yet. Not that you should do it. I'm just going to hold off a little bit. One of the things that we talk about as we get towards the end of the year is where's the gap? Where's the next deal going to come from? And I don't think it's foreclosures, and I don't think that it's necessarily prices dropping, but you might see some fluttering in the Airbnb market, in the short-term rental market. And here's what I mean by that. Let's just suppose that not every single house has the state license, the county license, and the city license to do short-term rentals, those that are less than 30 days. And let's suppose that there's an increase in violations and fines going out there, or nasty grams, and maybe some of those people are thinking of selling. Well, the ROI that they made off that property, if it's not going to be short-term rental and down to, let's say, monthly rental, that's going to be less ROI for them. They may be more willing to move on from those properties. I'm not saying at a discounted price, but it may not be the pricing that you could get on the ROI if you were calculating the higher amount of rent for short-term rentals versus a little bit lower, more consistent overall of the monthly rental. And when you're doing a calculation of a property value based on the net income, that does change the valuation on it. So I would watch for properties that you may choose to rent long-term that used to be an Airbnb. Or if you're so inclined to go out there and get all the licensing in place, if it's available, that might also be a gap where you might be able to make a savvy investment. The fact is that when you have a short-term rental, the money can come in kind of fast and furious, and it's exciting. And when it goes to the boredom of making money every month with not a lot of the extra excitement in there, some investors, they really enjoy that piece of it. So they may get bored of the property, and that could also be an opportunity. Now, we get it for half price? God, no. But could you get it for a little bit less? Maybe, based on that seller's motivation. And as we move towards the end of the year, I got to believe that there are some people that will want to sell for tax reasons, maybe to offset some gains or take a loss, or maybe they've got a loss already that they're looking to wash out with a gain on sale. I know that there's also concerns about what taxes look like in 2022. Will they change under the IRS codes? I expect some sales based on pain, either lack of sexiness in your Airbnb, or maybe you want to take your gains and your profits in 2021 because maybe your tax basis is going to be lower this year than next year. Now, what does that mean in plain English? Let's say that your taxes are going to go up 10% next year. Well, that means that by selling this year, you could save 10% on the gain that maybe selling for 5% below market value kind of washes out. It isn't such a bad thing because if the market shifts a little bit, and I don't think it's going negative, but what if it goes negative in 2022 and you pay more tax on your gain? An investor might be looking at if they're going to cash out. These are clues and signs that I want you guys to be watching for. And if you don't want to watch it, well, then just keep checking in with me and I'll watch it for you. All right, so how's that? So that's your bonus. If you don't want to do the math, we'll do the math for you. But I guess your prescription is keep listening. We're going to keep this short this week. There's a lot going on with the holiday weekend, and all around us, there's so much to really be watching on the news. I'm going to keep this one short for you guys. We'll check in next week. If you got questions, throw them in the chat so I can respond to them and put them in the next episode. This is Ron Wysokarski signing off for the Black Hole of Real Estate. Well, we are glad to be back with you today. The real estate market continues to be on fire, and now that we enter the summer buying season, if you will, things should even heat up just a little bit more. And I'm excited to tell you a couple things that are going on that will make it a little bit easier and a little bit harder to navigate this market. Let's start with easy. So easy things are interest rates are still in that 3% rate. Matter of fact, somebody said they went up to 3%. So I thought that was easy because if the money is inexpensive, it's easier to qualify. And a lot of people are concerned about inventory. But what I notice is that most markets have a 2 or 3 month supply. So if your market is selling 500 homes a month and there's 1,000 or so homes, there's 2 months supply. And as long as properties are coming on the market and going off, there's still properties to buy. Now, we would have a real big problem if there was 1,000 sales a month and only 500 homes available. But in this example, there's homes to buy. Now, will you have to perhaps take a few things off your list on the taste and preference side? Sure. We've been doing it for 2, 3 years right now. It's not all that different. But we did an exercise and I draw back 8, 10 years ago. And wife and I, we sat down, we looked at a particular price point. I don't know if it was 300, 400, or 500, but we said, let's just move it up. And I'm sure we got to at least a half million and could not find everything we wanted. And I can assure you at the time, we were nowhere near that price point as far as what we can, pay. We were somewhere, in the median, if you will. So he says, let's just try 600 and then 7 and then 8. And now we're up to a million. Now we are 2 to 3 times what we could actually pay for a house at this time. But what was interesting, even at a million, there were still things we wanted to change. It was still missing something. There was still something that either had to be renovated or taken out or move a wall. And I guess what I want to say is no matter what price point you're in, there's going to be something that's not quite right or not quite perfect. I would to say perfectly imperfect. And I think that's what we are. So whether you're in the 100 to 200 price point or a little higher or even a lot higher, I think it's easy to get caught up in the house not having everything that you want. I'm not quite sure I've ever sold a whole house that ultimately had everything the buyer wanted. It has everything we want, but and what comes after the but? Those couple of things. But I think it's easy to get caught up in that right now. And as homes are available, they continue to sell and people are buying them. And then they make it their own. And that's the difference. House is what you purchase, home is where you live. And right now, I see a lot of houses becoming homes. And the properties that sold last year that weren't quite right, I'm getting calls right now and hearing about all the renovations going on, how those things are going well. And those houses have absolutely become homes. And we're excited about that. We're also hearing about supply chain and building materials, and it's going to be permanent until it's temporary. Another perfectly imperfect situation. We see that the cost of materials, lumber specifically, 4 to 5 times what it cost a year ago. It's definitely driving up the cost of building a new home, and it's definitely impacting some of the new home starts. No question about that. So as we have new home starts uh, decreasing by about 4% month over month, it causes me to wonder, is that something we expect to see for the next, I don't know, 30, 60, 90 days? Maybe, maybe not. There's an interesting thing that took place as the tax day came through in April and May for personal and for business. And I realize a lot of people are filing extensions. But there's a reality that a lot of people did better in the last year than they would have imagined. And others just held off on doing things, not knowing what the future might look like. And as things open up right now, I do believe that we are going to find something, and I mean something happening, that will cause this market to have some more housing starts despite the increase in the cost and the materials. And ultimately, the prices will likely continue to be higher, median sales price, throughout the rest of the summer and probably going through the rest of the year. Interest rates, even though they're talking about going up, we've been hearing that for about 2 years right now. I don't see it this year. So, things get easier and harder at the same time. So, interest rates are easy, and even a shortage of materials um, might be a little bit more difficult. But ultimately, we're going to find that there is going to be some distance in this market, and people will continue to buy, and they are going to continue to move this market upward as we see more and more properties coming on the market. Now, another thing I would love, love, love to tell you about is what is going to happen when all the rates go up, when inventory gets flush and full, and there's a lot of houses to choose from. And I would tell you to save a little bit of that energy because I don't think rates are going up anytime soon. I don't think you're going to see tremendous amounts of inventory available anytime soon. And I also think that we are entering a market right now that while it feels like it's uncharted waters, ultimately what's really going on is that I think we know what's going on with this market. We understand what happens when properties go on the market and everybody looks at them and then multiple offers come in. We've seen this for last couple of years. I don't think that changes too much. When does it get back to normal? This may be the normal for many years to come. There's such a gap in the inventory level right now, specifically in Florida, that it's not going to be overcome in a month or probably not even in a year. Quite interestingly, a number of people continue to move to Florida, but for different reasons than the past. And when they talk about 1,000 people a day coming to Florida, we've heard that for years and years. And maybe this is the year where, I don't know, does it hit 2,000 a day? I can tell you this, that there is cash coming from other markets seeing Florida as a relative bargain, whether it's because it's more open, because there's no state level income tax, or maybe it's just the weather or the things to do down here. Because the state is opening up a little faster than some of the other areas of the country, there's a lot to do. And the summer vacations are definitely back right now. And you want to talk about interesting. The roads are busy, and it's not just Memorial Day. People are ready to be out, and they're excited to be out. And the calls are coming in. So, we vacation down here all the time. We always say this is going to be the year, but now it's like, well, why don't we just come to where we vacation? We like it down here. It's, without playing the political card right now, I do believe that people have definitely enjoyed some freedoms in Florida that perhaps were not available in other states. I mean, it's evidential right now. It definitely wasn't. And we can all remark whether it was safe or unsafe or right or wrong. Fact is, it's occurred that way. And it's very likely Florida is on the road to recovering in many areas a little quicker than the rest of our country. So we'll see additional supply chain things in Florida, different things like that. The cruise lines are not quite open for Cape Canaveral, but interestingly, they made up that gap. And this is less of a real estate topic and more of a supply chain topic, but it affects real estate. A record number of deliveries through Port Canaveral last month came through, and it wasn't with cruise ships and it wasn't with people. Any guess what it was? Lumber. Lumber from Canada, lumber from Europe in record numbers. They had more lumber come through Port Canaveral than ever last month. So, the help is on the way from places you wouldn't expect. Maybe Canada for lumber. I didn't think Europe was a place that lumber was going to be more accessible than from the U.S., but it's in Port Canaveral in record numbers. So I thought that was really, really interesting. The demand, is finding supply, and that supply is coming from places that we didn't expect. And and that's our next topic. What are we seeing that we didn't expect? We expected that home starts would drop. We expected that interest rates would probably stay the same. And maybe we even expected buyers to continue buying properties. Uh, the willingness of first time home buyers in this market to go above and beyond and make fast decisions and make really, really strong offers. I think that was a little unforeseen. I think there was some concern that first time home buyers would be shut out of this market by cash buyers and investors and relocation buyers with wads of cash from selling in other areas of the country. And the first time home buyers, they've taken the gloves off. They come out fighting. And they're not all first, young 20 somethings, but a lot of them are. There's plenty of first time home buyers in every age demographic, the 20s, 30s, 40s. We've had 60-year-olds buy their first properties. So it's not just an age thing. However, I will tell you this young group, they've got some really good jobs. They're used to working from home at this point, and they're making good money. And they're fighters, and they're duking it out with some of these cash investors and getting really creative in their offers, in the way that they're presenting them, and they're savvy. And I'm excited that among the first time group, they're fast learners. They see how the market is being played. And I'm not saying they're gamifying it right now, but they're competitive. So if you're a cash buyer and you're relocating the area, or maybe just overconfident at this point that your cash will trump all, I got news for you. Most sellers, if it's a matter of 5 grand, they'll wait a few extra weeks to get it from a loan, from a savvy first time home buyer that's willing to pay more than a cash buyer. And in the past, cash got you a discount, and while in some cases it might, not as often as you would think. So, thumbs up, first time home buyers duking it out and coming in strong right now. And maybe that's something we didn't expect to see. I look forward to catching up with you guys throughout the summer right now, and I hope that you have an awesome, awesome week. This is Ron Wysakarski for the Black Hole of Real Estate. Welcome back to the black hole of real estate. And we've got a couple of things that we should be talking about this week. The first thing is the foreclosure bans have been lifted, and there's still some conversation about how that actually is put into play. We're also looking into this incredible increase in price for building materials. And that seems to have some effect, but maybe not as much as you think. And then the last thing, this bubble crisis that we're all facing right now, there's a lot of information coming out that's talking about a crash of the market and foreclosures. And at the end, I'm going to tell you why I feel the way I feel about that, but I'm not going to tell you about that till we talk about the other things. So, first up, the eviction ban, the foreclosure ban, those are all being lifted right now. And there is some talk in the municipalities and courts of the area to kind of do their own thing. And it's a little tricky on the property management side right now. You've got the go ahead that says, hey, you can evict again. But then there's other procedural things like any eviction that also get in the way. So it's not that, okay, hey, you know what? Eviction ban's over. You're out the house. It's not that easy, but the path is back in place to get back to a more familiar system of evictions. And that's what we'll be seeing over the summertime, probably after June 30th. It looks like that's what's going to be taking place. So this just in, we're back to the old days where if you pay, you stay, and if you don't, you won't. And maybe that's insensitive. Maybe somebody has a good reason for that, but the person who owns the property has a good reason for renting it out. They may need to pay a mortgage, they may need to pay a debt, or they invested that money to have income for some other purpose. So, we'll just see how this plays out. But right now, I believe we're heading back towards eviction land. How's that? So we'll see how it plays out. And it'll be an interesting summer for that for sure. Same thing with the foreclosures. And if you're waiting around thinking this is the year going to get that great foreclosure at that great price, I don't see it. I just don't see it. Prices have risen so dramatically in the last few years that if anybody bought in the last few years, typically say, oh my God, they can't get out. By the time they pay commissions and fees and taxes and late fees, they're not going to get out. Prices have gone up significantly. My suspicion is that somebody who didn't pay for their house last year under forbearance that can't pay for it now or won't pay for it now that is heading towards a foreclosure can simply put it on the market and sell it and clear some cash. Now they're going to have to figure out a place to move into, but maybe there'll be some new open vacancies in the rental market. They're probably not buying again anytime soon because going through forbearance and then all the things go with it probably is not good to get a new mortgage if you don't pay for it. But we'll see. We will see on that piece. But even if a house unlikely somehow makes its way to foreclosure land, it's still got to go through the whole process, which could be 3, 6, 9, 12 months, and every kind of, I would say, strategy, not tactic, to delay that foreclosure. At which point, I would think some bank, some trust, some real estate firm, some hedge fund, somebody's going to slide in. I'll just buy them in bulk. I don't think they ever make it to the market, is what I'm saying. I think it's the rare property that makes it on the market right now is a foreclosure. It's a few percent of the market compared to like 70% in 2008, 9, 10, those years. I just don't see it happening. And prove me wrong, and we'll deal with it. It's not really a good thing to see all those foreclosures. I think if you're opportunistic and an investor, you might want to see it, but there's still deals in this market, even as we speak, with super low inventory. I won't spend a lot of time talking about inventory. I'll just say, you know what? It's low. Okay, that's not news, but that's the space that we're in right now, and that's what's going to continue to happen. Um, the thing that everybody has on their mind right now is when's this bubble going to burst? When's this surge forward going to stop? I'm an evidence guy. What caused this market to surge forward? I'd say a lot of people want to move or invest in properties so that people can move into their rentals. But movement is the key. And a year ago, we had a COVID thing and lockdowns, and that really didn't stop a lot of people from moving. That's a pretty good reason to stop moving, and yet they didn't. So I don't believe that people don't want to move. because it didn't happen last year, and I believe it's going to happen this year. And people move for reasons other than market prices going up or down. They move because they want to move. Their life situation has changed, and if that is uh, adding a spouse, deleting a spouse, if there is a baby coming in, or maybe there's one going to college, there's all these reasons to upsize and downsize and blend your families and move in together. You know, there are estates and trusts and reasons, and investors sell too. It's a high market. Some investors are, saying, "Hey, you know what? Let's just cash in our chips over here. It's been a good run." There will be inventory that will come onto the market. But again, people wanting to move, that's what caused this to happen. And we can talk about housing shortages and anything else that you might imagine. But there's a shift in population where people are moving away from certain areas. See, not every market has an inventory shortage. A state like Florida, where a lot of people are moving to, perhaps Texas, and there's some other ones out there, where there's a large influx of people coming from other states. They're causing shortages because there's just this giant influx of people that are buying up the properties that are available right now. And new construction simply can't keep up with the demand. And yeah, you know what? That bit about building materials prices I talked about earlier, there's statistics out there that lumber is 3, 4 times what it was this time last year. We know that labor could be double, materials could be 2 to 3 times higher. It is adding to the cost of building a brand new house. So prices are going up not just because prices are going up. They're going up because the materials and the things that cost to build the house are going up. So some of the lift in this market isn't all about bubbles and prices being driven up. It's the cost of building the homes that's going up. There's a lot of reasons that market rise, and it's not always the one that you think or identify or being told. What if somebody came to you and said, listen, my real estate business is up 30%. Well, if the market's up 40%, that's not good. Well, what if somebody also said that housing prices are up 20%, but building materials are up 30%? Maybe it's just the cost of materials. Maybe the house isn't any more valuable on its face as an appreciation tactic. There's an inflation piece that's in this, and we have to be aware of that. Let's not be caught into the disguise of the numbers. Let's understand there's a lot of reasons that prices are moving up. And certainly demand for people moving from one state to another certainly is part of it. Lower inventory, low inventory isn't as much of a factor as you think it is. As long as you've got 2 months supply of inventory, we saw in the condo market that there was about 250 condo sales in the Daytona Beach area in the last month. There's over 500 condos available. Now, it's less than 1,000 available last year, but it's a 2 month supply. And as long as more inventory is coming on the market, there'll be enough for a few months. I'd argue that having 6 months or 8 months or 10 months isn't necessarily awesome for the market either. It gives you a lot more to choose from, but I don't know that really is awesome for the market. So I think we get tricked into low inventory as being a problem. It's the cost of moving. It's the cost of materials. It's the desire to move. It's having fewer choices to select from. I've been there with clients that have 15 or 20 good options. They don't make a decision any quicker when there's 15 or 20. And even then, I still can't find the right one. We hear it all the time. So I don't know that the inventory is as much of a problem as we're letting it be right now. And I'll just say it that way. Now, what I do think is a problem is interest rates. And when they eventually go up, that's probably the lever that's going to make a little impact on the market, but not a huge one. The price of the homes has gone up, the rates have gone down. It's actually a little more affordable to buy a house this year than last year. We talked about that last time around. With a $25,000 differential in median sales price and the rate going down about 1%, it's actually about $30 cheaper a month to buy a house. So that's not the reason. But even if rates go up another percent, you're talking about a $10, $20 increase in the monthly payment. Not enough to stop most people when the mortgage payments in the $1,500, $1,600 range for those. That's not enough. It's at 10, 15. That's a couple of cups of coffee at your favorite barista. That's not enough to stop most people from buying. When rates rise dramatically and they go from 2, 3, 4 up to 6 or 7, that could be problematic. But the Fed insists that's not going to happen, at least not this year. So if inventory is not the problem and people still want to move, well, that's not the problem. And materials cost more, it's unlikely prices are going to go down because it costs too much to build a house. And that supply chain issue that we're being told is the reason, maybe it is, maybe it isn't. There's nothing underpinning this market that can just have, get knocked out at the knees. So my suspicion is the prices will continue to increase for those reasons because COVID wasn't a problem. People just wanted to move. And the rates aren't a problem. There's not enough differential in the spread unless you see a dramatic doubling of rates. And the cost of materials hasn't slowed things down. And there's cash out there. Troubled homeowners with financial issues, they likely have enough equity to sell their property, have some profit, or at least a way to get to the closing table. This is not 12 years ago or 13 years ago. It's a totally different reason in the market. So if you're waiting for me to tell you that the market's going to crash and there's a big bubble ahead and you buy some gold bars and hide out in a cave, save yourself the effort. I don't think it's going to happen. Now, if you would just like to buy yourself some gold bars and hide in a cave, that's cool. And I support that. Just don't do it because you think the housing crisis is coming back. And don't be fearful of this market. Truth be told, I bought a condo last month. And I bought one last June. If I was fearful of this market, I wouldn't be buying. And so, I guess, what do they say? Put your money where your mouth is. I'm a buyer in this market. Despite the increase in price, I'm still a buyer in this market. I can't make that decision for you, but the excuses or reasons are minimal right now. So that's what I have for you. No bubble, not going to burst, just not going to happen. And if you're hopeful for it, well, there's probably a different podcast out there for you. Because on this one, we don't see any reason this market's going to stop or slow down. That's the word from me from here. So I'm glad that you guys took a little bit of time to listen in. And we look forward to talking to you the next time on the Black Hole of Real Estate.